This is where the internet gets people in trouble. Someone hears the rich write off everything, and suddenly they think a business is just a magical bin for personal expenses. It's not. A business can create deductions, but those deductions must be legitimate. The IRS says deductible business expenses generally must be both ordinary and necessary. Ordinary means common and accepted in the trade or business. Necessary means helpful and appropriate for the business. So, what does doing it right actually mean? It means the business must be real. A real attempt to turn a profit based on real products and services. A real record of income and expenses and separation between business and personal life. If your business model is, I occasionally think about selling things while scrolling Instagram, you are not a mogul. You're just a person with Wi-Fi. Step 1. Define the business activity. Are you selling fitness equipment, doing consulting, making YouTube content, selling templates, running a rental, freelance work? Yes? Good. Name the activity clearly. Step 2. Separate the money. Open a separate business bank account. Do not mix rent, groceries, date night, and business expenses in one account and then expect your CPA to read your bank statement like a crime scene investigator. Step 3, keep receipts, not just the receipt, but the business purpose. For example, camera light for YouTube recording setup, software subscription for bookkeeping, mileage to meet client, laptop used 80% for business content creation. If your receipt says laptop for business, but your browsing histories is 90% streaming, the IRS might see right through your quote unquote research. That's different from, I bought shoes and technically I wore them while thinking about entrepreneurship. No, unless those shoes were exclusively purchased for walking to business meetings and you've named your left foot LLC, that deduction is a fantasy. Step 4, track income monthly. If money comes in, record it. Step 5, track expenses monthly. Waiting all year is how you end up confused, missing deductions, or accidentally inventing fiction, claiming your dog is a security system for your home office. Unless your dog is a trained canine that barks at tax forms, it's not a deduction. Step 6, understand the difference between a business expense and a personal expense and a capital expense. Step 7, meet with a tax professional once the business becomes meaningful. Doing it right means the paperwork matches reality. Doing it wrong means pretending everything in your life is business related because you occasionally checked email near it. A business is not a tax invisibility cloak. It is a legal container, and the container only works when the activity, records, income, expenses, and tax filings tell the same story. There's no real method to hiding from auditors. If they don't get you today, they will come for you tomorrow. Don't create a deduction on your business account called your board meeting, especially when you're eating alone during office hours and you are the only board member. Real estate is one of the major reasons wealthy people build and preserve wealth. Why? Because real estate can combine appreciation, cash flow, leverage, depreciation, refinancing, and tax planning. But real estate done wrong is not wealth. It's stress with plumbing. And at 2 a.m., a leaking water heater doesn't care about your passive income dreams. The wealthy do not just buy property randomly. They track basis, numbers, and improvements. They understand financing, cash flow, and they know whether the property is a primary residence, second home, rental, or investment property. And that classification matters. The IRS says homeowners may qualify to exclude up to $250,000 of gain from selling a main home, or up to $500,000 for married couples filing jointly if requirements are met. For investment real estate, a 1031 exchange allows a taxpayer to defer capital gains taxes by swapping one qualifying business or investment property for another like-kind real property. Think of it as the tax code's version of Freaky Friday. You trade one property for another and the tax bill stays on pause, as long as you follow the rules and do not accidentally trade into a worse asset. So, What does doing real estate right look like? Step 1, know what the property is for. Is it a home, rental, future rental, a flip, a long-term hold, or house hack? You need to know the purpose because the tax treatment and record keeping may differ. Step 2, track your basis. Basis generally starts with what you paid for the property, but it may include certain closing costs and capital improvements. Doing it right means keeping records for purchase documents, closing statement, major repairs, capital improvements, renovations, roof replacement, HVAC replacement, additions, appliances, flooring, receipts, contractor invoices, and before and after photos. Step 3, separate rental income and expenses. If it becomes a rental, create a separate bank account. Track rent deposits, repairs, mileage, property management fees, insurance, mortgage interest. Track taxes, HOA fees, utilities if you pay them. Do not guess. Guessing is not a system. Guessing is how you end up telling an auditor, I'm pretty sure that was for the toilet. And the auditor replies, there's no toilet in that line item, just a series of DoorDash deliveries. Step 4, understand depreciation. Now, rental property may allow depreciation deductions, but depreciation also affects future tax consequences when sold. This is where people mess up because they love the deduction, but forget the future recapture issue. It's a back to the future scenario. You enjoy the present day deductions, but one day Doc Brown shows up in the DeLorean and you owe back taxes from the past. Step 5, before selling investment property, talk to a CPA about the sale before the sale happens. Because a 1031 exchange has strict timing and process rules. If you sell first and ask questions later, you may have already missed your opportunity. Step 6, keep a clean file for each property. One property, one folder. Purchase documents, loan documents, insurance, lease agreements, repair records, improvement records, tax returns, tenant communication, and photos. It's not glamorous, but wealthy people aren't wealthy because every move is glamorous. Sometimes wealth is a folder named property records that someone actually keeps updated. That folder is the financial equivalent of flossing. Sure, it's not exciting, but it prevents a world of pain later. Doing it wrong looks like this. Buying a property because someone said real estate always goes up. Ignoring cash flow, forgetting maintenance, mixing personal and rental money. Not tracking improvements, selling before asking about taxes, treating depreciation like free money with no future consequence. Real estate can be powerful, but the numbers must work without fantasy. If the property only makes sense when nothing breaks, nobody moves out, interest rates behave, and the roof respects your feelings, then the property does not make sense yet. Real estate and business give you the legal container, but debt, that's the fuel that fills it up. Most people run from it. We're about to learn how to weaponize it. That's part 4 of the poor man's Billionaire Playbook. Now look, if this series has sharpened your thinking so far, don't just watch. Tap the like button, subscribe. Let the algorithm know that these are conversations worth having. Part 4 is where we separate the truly wealthy from the perpetually undisciplined. In Debt, a tool for the wealthy, a trap for the undisciplined. See you then.